Hey there. Welcome to session 12 of 30, the Startup Money Playbook. And in this topic, what we're going to discuss will be the three-statement financial model. And this is one of the most important skills in financial modeling, and the one most founders, skip. So what we're going to learn in this session is how net profit flows into retained earnings, how CapEx moves from cash flow to fixed assets, how closing cash must match across statements, and how one assumption change affects, everything. So by the end of the session, you will be able to build a fully linked financial model. So let's get started. We're going to see the recap first, what we learned in the last session. That was session 11, right? So point number one that you see here is, and you may recall, budget is a plan. Okay, forecast is your best estimate. Budget is always fixed, forecast is updated monthly, and bottom of forecasting is more credible. Point two that you see actually, and you may recall, three scenarios are required. Okay, we had the base case, which is for operations, then the bull case, investor story, and the bear case, which was the survival. We saw some StudyAI example also. If you remember, the base case was 63.7 lakh, the bull was 1.04 crore, and bear survival was 32.1 lakh rupees. Point three that you see here is monthly variance analysis must be done, usually on the first week of or maybe 5th of every month. And every gap needs a cause and an owner. So today we go one level deeper. We connect all three statements into one system. So before that, let's dissect. Let's understand this entire agenda. We'll start with the hook, and that is why most models are broken. Then, of course, we'll talk about the three links, the core connections, full connection map, and then we have the live model build, one change with full impact. Then we'll go and study sensitivity analysis, what matters the most. And then there are common errors. In fact, there are 5 common errors. What is going to break a model, right? So by the end, you will be able to build, verify, and trace a full financial model. Okay, so your model doesn't balance, and the investor knows about it. A model that doesn't balance is actually not a model, it's just 3 disconnected spreadsheets. Okay, so look at this. An experienced investor receives a financial model from a Series A founder, which means the founder has raised a Series A funding. Now she opens the file, and in 30 seconds she runs 3 checks. Okay, check 1 is cash on the balance sheet equal to the closing cash on the cash flow statement? That's the first check. The second, are retained earnings equal to prior year retained earnings plus net profit? The third check is, do assets equal liabilities plus equity? If even one of these, fails, she closes the model. The meeting is essentially over. Because this tells her one thing: if you cannot link 3 statements correctly, you have not modeled your business. You've just guessed it. Now, understand this clearly. These 3 checks take only 30 seconds, and most founders skip them completely, right? So, what a correct model must do: first is, balance sheet must balance, of course. Assets must always equal liabilities plus equity. Even a difference of rupee 1 means the model is wrong. So don't do that adjustment. The second one is, cash must reconcile. Closing cash from cash flow statement must equal the cash on the balance sheet. And this is the most important common error. Third one is, retained earnings must link. And the formula is very simple. Retained earning this year should be equal to retained earnings last year plus net profit minus the dividends that you would have given to all your shareholders. If retained earnings is manually entered, okay, then there is a red flag. So the final thought is a true financial model does not depend on manual entries. Every number flows from one statement to the other. So what essentially is talking about is this entire financial statement, all the worksheets are actually interlinked with each other, with one another, in fact. So if you change anything in the P&L, it should automatically get reflected in the cash flow, right? So there should be no guesses. Now let's look at this. Three connections, everything else follows, right? Master these three links and every model you build will balance automatically. So now let's understand what these three connections are. Okay. So everything in a financial model connects to three links. If you understand these three, your model will always balance. Link one is profit and loss statement to balance sheet. That's the connection. So net profit, flows into retained earnings. Every rupee of net profit that is not paid as a dividend is added to retained earnings. And when you add that to retained earnings, what happens is your equity actually increases, right? Because retained earnings section is in the balance sheet. And the formula is simple. Retained earnings at the end should be equal to retained earnings at the start plus net profit minus dividends. Now, the StudyAI example, if you look at the retained earnings at start is 0, net profit is 43,19,963. Dividends 0. It's completely with Aryan then, right? Um, so how will you do that? So 0 plus 43,19,963 minus 0, the answer remains 43,19,963. The link 2 here is cash flow should be connected to the balance sheet. Okay. So closing cash must match the balance sheet cash. And the formula is simple. Balance sheet cash should be equal to the opening cash, right? Plus the net change in the cash. Let's take an example. So the opening cash of StudyAI is 2,22,000 rupees, right? So net change in the cash is 44 lakh 41,843. You just need to add these two and you get 46,63,843. This number must exactly match the cash on the balance sheet. Link number 3 is P&L plus balance sheet to cash flow. So what does this mean? This means CapEx and working capital flow into cash flow. Okay. So let's start with this. Operating cash flow formula, it will be very simple. Net profit plus depreciation plus or minus working capital changes, right? In case of StudyAI, the net profit is 43.2 lakh. Depreciation is 16,667 rupees, right? We'd already discussed, you must go back to those sessions, right? This was the laptop case, right? Then the working capital changes is 2,67,268. So how do you do that? Very simple. 43.2 lakh plus the 16,668 that you add plus 2,67,000, right, 268, and then you're going to get 45, right, lakhs. So the final insight is these three links connect all three statements, and if these are correct, your model will always balance. Now let's correct everything. This slide shows where each number comes from and where it goes, okay, across all the statements. So from P&L to balance sheet, so revenue does not go directly anywhere. It actually drives the net profit. So net profit flows into retained earnings, and then net profit is actually the starting point to the cash flow. Okay, a starting point of the cash flow from the operations. Depreciation is then added back in the cash flow, and it also reduces fixed assets on the balance sheet. CapEx flow, if you talk about so capital expenditure, it appears in the cash flow statement as an outflow in the investing. and it increases fixed assets on the balance sheet. Then working capital flow, if you want, changes in receivables affect, cash flow from operations, and they appear under current assets. Then changes in payables also affect cash flow. They appear under liabilities. Receivables, uh, you're yet to receive. Okay, so you've not received it. Payables, you have to actually pay. You owe, right? So that's why this will become the liability. Now, financing flow, let's understand. If a loan is raised, what will happen? You get the money, so cash increases in the financing section. You remember those three, within the cash flow we had, right? CFO, then CFI, right? So yeah, so if a loan is raised, cash actually increases in the financing section, and the long term liabilities increase, because loan, if you're taking, obviously you're going to pay it after a year. Now, if a loan is repaid, what will happen? The cash decreases, and when the cash decreases, the long term liabilities will also decrease. So the final link is the cash, closing cash from the cash flow statement. It must be equal to the cash on the balance sheet. Okay. And that's why you can actually see every number is connected. You just download that sheet, right, and you will get everything. So nothing exists in isolation. If one number changes, multiple statements change. We'll take the study AI example, and we'll see how the three statements are linked, right? You change one assumption and watch everything else will change. For example, if you change the price from 99 to 129, what happens is, right, through the P&L to balance sheet to the cash flow, everything will automatically change. Okay, let's look at that. Right. If you slightly increase the price from 99 to 129, what happens? Volume remains the constant, that is 1200 downloads per month, but the revenue will obviously increase, right? That is the first one. So now 1200 will now be multiplied by 129. And you know what happens? Now it is 18 lakhs 57,600 compared to 14 lakh 25,600. So there's an increase of 4 lakh 32,000 rupees, right? Now you look at the razor pay fees. Obviously, when you look at this 129, because 2% you have to give. Now this is increased from 1 lakh 80,000 to 1 lakh 30,200. So there's an increase of 29,400. You just look at the gross profit. There's an increase in gross profit as well. It's a 4 lakh 2,600. And when you talk about the net profit, which in the case of 99 was 4 lakh 36,836, but now it has increased to 8 lakh 68,836. So there's also an increase of 4 lakh 32,000. Okay. Now we will see this. So retained earnings increase. You look at the balance sheet impact. Okay. From 4 lakh 36,836, it will now become 8 lakh 68,000. So there's an increase of 4 lakh 32,000. So total equity is also going to increase by the same amount. Okay. So total assets also increase by that amount. Okay. Because the cash has increased. Now look at the cash flow impact. In the operating cash flow, right, 491,836 now has increased to 923,836. There's an increase of 4,3. So closing cash, if you look at, it was earlier 4,75,000. Now the closing cash is 9,07,000. So this 4,32,000 rupees is actually getting added everywhere, right? Okay. So one change adds this to revenue, to net profit, retained earnings, equity, assets, and cash, and everything else moves together automatically. Now let's answer this very important question. Which assumption has the biggest impact on profit? Okay. So we look at the effect of a 10% change in every variable. 10% means from 99, if you increase the price to 129, right? Or let's say, so we'll actually do first, we'll start from the base price 99. Well, let's reduce it by 10%. And when you reduce it, it will become 89 rupees. The net profit at minus 10% is 6,85,236, right? And when you increase it, it is 14,68,000. So the impact is really high. You look at the difference, right? So there's a huge difference, close to 12 lakh rupees difference. Okay. You take the case of monthly downloads. If you reduce it by 10%, 1200 downloads, just reduce it by 12%. We have also seen in one of the earlier sessions, right? And it's now reduced to 1080. Your net profit will be 7,55,636. But if you just increase it at the 10%, it will be 13,18,036. Okay, look at the churn. Okay, you just increase the churn from 3% to, let's say, 3.3%, because there's a 10% increase in that. Okay, so that's how it is. Net profit, we've already seen. At minus 10% is 9,54,000, but at plus 10%, it is 11,49,000. But we don't see enough a big change, right? From, like, there's an exact, I think, 2 lakh rupees. So it's a medium change, we will say. You look at the variable cost, which was earlier 7 rupees, right? Now, when you increase that to 10%, it will be 7.7. Okay, so net profit at minus 10% will be 10,29,636. And at 10%, plus 10%, it is 10,75,036. So when you increase the variable cost, what you're actually seeing, your net profit is by and large the same. There's hardly any increase. There is, I mean, it's very nominal, I'll say, very low. Okay, now let's take the fixed cost. The basic 69,000 rupees per month. And now if you increase, to 76,000, 10% increase. At minus 10%, net profit is 9,55,000, right, 236. But at plus 10%, it is 11.5 lakhs. So it's from low to medium, I'll say. Okay, just take the OPEX, and let's take the the parameters that affect. Let's take the salary of this content writer from 18,000 per month. You just increase it to 20,000. Okay, so at minus 10%, your net profit is 10,62,000. At plus 10%, right, your net profit is 10,90,000. So there's a 30,000 rupees, or even much less than that, 28,000. So it's quite low if you look at. So the final insight is price is 6 times more impactful than churn, and 20 times more impactful than variable costs. So if you're a founder, 80% of your attention should go to pricing. Okay, so let's look at the most common mistakes that break a financial model. The first error that we actually see is the hard-coded numbers. Numbers are typed manually instead of using formula. Please don't do that. I mean, learn a little bit of it. It is very simple. Take one X, cell, put an equal to sign, right? And use the formula. If you have to connect it to the previous sheet, you don't have to do anything. Just go to that particular sheet and automatically the formula gets reflected. Okay. So don't do it manually. The problem is when assumptions change, the model doesn't change. And when you look at your financial sheet, which maybe, may have, 5 to 10 tabs, and it will all be filled with numbers, you'll get confused. So it's recommended that every sheet must be connected. So the fix is every link must have a formula, not a type number. Error number 2 is cash not reconciling. Yes, cash flow closing balance does not match the balance sheet cash because the model is broken. This is the first thing every investor checks. Ensure closing cash equals balance sheet cash. The third one is retained earnings entered manually. Retained earnings is typed indirectly. So equity does not reflect actual performance. So you have to use the formula previous retained earnings plus net profit, right, minus the dividends. It's very simple. Initially, you may not have dividends, you may not have to pay that, so it'll always be zero, but please use this formula. Error number 4 is depreciation is missing. Depreciation is not linked properly. And the problem here is the model becomes incomplete. And how do you fix it? Depreciation must reduce net profit. So it's very simple. So reduce net profit, reduce asset value, and be added back in cash flow. Right. Error number 5 is working capital is ignored. So changes in receivables or payables are not included. Cash flow becomes incorrect. That's the problem. So profit becomes equal to cash, which is almost never true. So fixes always include working capital changes. So the final insight here is every one of these errors can break your entire model and reduce investor trust immediately. Short session, I believe, but let's have a quick recap. Point 1 is very simple. 3 links connect everything. Net profit flows into retained earnings. Closing cash from cash flow statement must be equal to the cash on the balance sheet. CapEx flows into fixed assets and cash flow investing. Then point 2 is one assumption changes everything. We saw the 10% increase in the price, right? Revenue increases by a certain amount and the same amount flows into the net profit. Everything else, okay? We took that StudyAI example. Point 3 is price sensitivity is the highest. A 10% increase in price adds 4,32,000 as annual profit, which is really, really remarkable when you're starting a business. Okay. A 10% improvement in churn also adds only, 49,000. So think about it. So sometimes you may have to make a trade-off, maybe at the expense of losing a customer or a few customers, you may have to work on increasing the price. Think about it. So price has a highest impact, okay, or a much higher impact at least. Then 5 errors break the model. The hard-coded numbers, then cash mismatch, retained earnings, manual entry, and then missing depreciation, ignoring working capital. Anyone can actually break the model. So financial model is not about numbers, it's about how these numbers connect.
It's 2 o'clock.
Now it's time to apply when you have learned. This week's task is very simple. Link your 3 statements together. Now follow these steps carefully. Open your 3 templates. T1 is profit and loss, T2 is balance sheet, and T3 is cash flow statement. Should do it right now. And because they're not connected, go to the balance sheet, find retained earnings, replace the manually entered number with a formula. Retained earnings equal previous retained earnings plus net profit linked from T1. And still in the balance sheet, then find the cash flow line, then replace it with cash equals closing cash linked from T3. Now go to cash flow statement, find the starting point for cash flow from operations, then link for net profit. Link net profit actually from the profit and loss statement. Okay, verify 2 things then. Does the balance sheet balance? And assets must equal liabilities. That's how you check it. And then the second one is does cash match, which means closing cash and cash flow must equal cash on the balance sheet. If both are correct, you have a linked model. Okay, now change one assumption, just do the 10% increase, and then see how these 3 things are working. If yes, you have actually built a first 3 statement model. Okay, you have to use you can use template 8 linked 3 statement. It includes pre-linked statements, auto balance check, sensitivity tables, scenario toggle. Right. So what's the modeling tip of the week? Add a checks row at the top of your sheet. Check 1 is assets minus liabilities minus equity must be equal to 0. It's another way of looking at it. Check 2 is cash flow closing balance minus balance sheet cash flow must be equal to 0. Hope this is correct. So if both of them are 0, model is correct. If you want to build like a founder, you must model like 1. As simple as that. In the next session, we move to a critical question for every startup. That we'll talk about the burn rate and runaway. And this is where finance becomes survival, right? And you will learn the difference between gross burn versus net burn, what you spend in total and what you actually uh, lose after revenue, right? And we will use the runway exact formula. Runway equals cash balance divided by net burn, and this gives you number of burns your startup can survive. And 3 ways to extend runway without raising capital. You can cut costs, increase revenue, and collect receivables faster. By the end of the next session, you will know exactly how long your startup can survive. So session 2 is 12 is complete from my side, and you can now build a 3-statement financial model that balances automatically. Remember the core principles. 3 links connect all 3 statements: net profit, closing cash, and capex. There should be no manual entry. Everything must be linked. One assumption change must flow through all the 3 statements automatically. And most importantly, price sensitivity is the highest. Focus there first always. Okay, so check your model, trust your numbers, build with clarity. See you in session 13. Thank you so much for watching. Do subscribe, like, take care.